The Nikkei is at new all-time highs, and Japan Inc. looks like it may be turning over a new leaf.
We're going to take a look at Mitsubishi also to see how that comes alive.
Let's talk earnings and favorite pastime.
So let me just say, earnings
hit it
by
with Wall Street.
It's
Why do they
2.5x
because
their compensation goes up.
Wall Street's wrong again.
One of the biggest bull markets the last few years has been the Japanese market, which I think that if you talk to anybody over the last decade, they would have said, no way, impossible. And part of the reason why recently the Japanese market is on a rally is because of the fact that they just initially decided that they are going to have a new prime minister, Sanae Takaichi, who is specifically focused on the idea that she wants to follow in the steps of Abenomics. And if you look at what really is going on in terms of this, I mean, this whole entire story, Joel, has been a story about, a country that believed in what's called stakeholder capitalism, everyone. The idea that, you drive, you run a company to make sure all the stakeholders, including employees and everybody else, are satisfied, not for shareholders. And all of a sudden, it seems like, Joel, we're unlocking shareholder capitalism in Japan, and it's just changing the whole entire story. Or you might have a certain reservation, but it seems that way if we go through it, right?
Well, I mean, the idea of stakeholder capitalism, right, ideally is that everybody wins. The consumer wins, the employee wins, and the investors win, and the general public as a whole. The issue is a lot of companies in Japan have been overly favoring the employees, sometimes the customers, and not the shareholders. And how do we know? Mm-hmm. Because the Nikkei peaked in 1990 and hasn't come back for about 20-something years until the last few years where they're saying, okay, maybe they're finding a balance between employees, customers, and shareholders have to win, because if the shareholders don't win, then companies don't have money, the cost of capital is more expensive, the stock market doesn't well, and then everybody loses. So they are finding more balance. I don't think they're walking away from employees or customers, but they're walking into a situation that says, can we balance that shareholder piece a bit better? And over the last several years, it would appear that they are heading that direction. Yes.
And so everybody, just to take you back, I remember this story that we're about to talk about, kind of the beginning of this, in terms of where Japan came from. Because if you look, right, I mean, from 1989, from the peak to basically the bottom, which is around 2010, a big reason why it was because Japan Inc. was incredibly antagonistic to investors. And I'll always remember this because Steel Partners was back at the hedge fund that I worked at, Joel, at the Abernathy Group. We actually were invested in AdaptTech. And I'll always remember this because AdaptTech, everybody, which doesn't even exist anymore, it was a company that was trading at below cash levels. And Steel Partners, Warren Lichtenstein, if memory serves me correctly, came in and basically tore it apart and took it over. And that's what we liked about it, because Steel Partners was this aggressive activist investor. Well, Steel Partners tried to do the same thing in Japan. And not only did they get rebuffed by management, but in a testament to how antagonistic Japan Inc. was to investors, Bulldog Sauces, the company that Steel Partners tried to go active on, got the federal government to basically judges to say, yes, you can use any poison pill you want because we're not letting these Americans come in and take over Japan Inc. But then something important happened, and that important thing that happened was Abenomics. And so Shinzo Abe came into power in the early 2010s and basically said, look, we need to fix the not just perception but reality of Japan Inc. and how Japan Inc. interacts with people. And you can see it was really the beginning of the run of the Nikkei back, everybody. And part of the reason why was because Abenomics, what it was really focused on was the idea of, hey, let's start focusing more, to your point, Joel, not only shareholder capitalism, but more towards shareholder capitalism. Let's, think about things like peeling apart the interconnected shareholdings and stodgy board seats and, lack of communication with investors and all this other stuff. What was really interesting was, and Joel, when you and I were looking at this, you were even like, Japan still has terrible return on assets. But if you look everybody, yeah, go ahead, Joel. Yeah.
I mean, I've been going to Japan since early this century, and I've been there, 100 times maybe. And I remember 20-something years ago, people saying and meeting with some big funds, and they're like, oh, things are going to change. Things are going to change. They're going to start turning things around. This is pre-Shinzo Abe. And they say, we're going to turn things around. I remember one hedge fund manager, a big firm out in Japan, was like, he goes, you realize that the Japanese flag, which is one big circle of one color, and he says, you realize it's a pie chart, and it says that all of Japan is Japan. They're not adopting other people's cultures and other people's ideas of how to look at companies, and I don't see it happening now. And at the time, he was right, but that was pre-Abe. Abe came in and said, no, we could do something in Japan that's different and still make it very Japanese, right? But make their version that says we just have to look at shareholder value. And as you can see in our aggregate returns, Rob, that you're showing a marked change.
Right. And so what happened, everybody, was, Japanese companies, if you remember from prior episodes in our conversations, Joel and I normally talk about the idea on a uniform accounting basis. When we clean up the accounting, what we see is in the U.S., average return on assets is around 12%. Well, in Japan, it was hanging out at around 2% to 3%. When the activity is really, really low. Cost of capital, everybody, even in Japan, which has a very low interest rate because of deflation and everything else, probably cost of capital is 4 to 5%. So it was hanging out below cost of capital. So what has started to happen, which was really interesting, was once Abenomics started to come into play, initially, it actually looked like it started to help boost return on assets. Companies started to focus on, hey, we got to actually do these things to be more shareholder capitalism friendly. Now, of course, 2020, you see an ROA dip back. Let's be honest, everybody, that's mostly COVID more than anything else. But what was really interesting was, for a while, everybody kind of said exactly, Joel, what you said. Everybody said, yeah, we'll believe it when we see it. Anybody who's invested in Japan knows change happens very slowly. But then Buffett in 2020 goes, hey, look, I actually think that something interesting is happening here. And he went and he basically bought sizable stakes in the 5 big Japanese trading houses, right? The Mitsubishis of the world, the Mitsus of the world, and everything else. And what he basically saw,
the massive change that occurred from early 2000s into 2017, 2018, then collapsed. And he's thinking, this collapse is a COVID collapse, not a Japan's given up on those Abenomics and more shareholder-friendly ideals. And if it pops back, because it really is just COVID, and the culture is changing a bit of how to manage companies and manage returns, this should be a great, great buy.
Yep, exactly. And so what's really interesting is, and then what happened after that was, so after, Abe was assassinated, right, Joel, I think 2022, basically there was a new group in power and everything else, continued to lean into the idea of, getting after this idea of shareholder capitalism, to the point that literally everybody, and this is something that, if you understand Japanese culture, the idea of being named and shamed in Japanese culture, there's probably nothing worse, I think you would say, Joel, in terms of, in terms of it, just the idea of, embarrassment.
Yeah, honor and dishonor at the highest levels of values that they have. And if it's seen as dishonorable or shameful, they will run from whatever that is, right? And they'll move to a thing that's more honorable.
Right, and so in 2023, JPX, right, the Japanese exchange, came out and basically said, you know what we're going to do? We are fed up with the idea that Japanese companies are not managing themselves for shareholders. We're going to start to name and shame anyone that has a price to book, right, traditional equity price to book, that is below 1. And we are going to keep on naming and shaming those people regularly until these companies start to fix.
In other words, in the Japanese economy, when you look at whatever we cover, 4,000 plus Japanese stocks, right? Yep. When you look at those companies, it's not that they're all getting a bad return. It's got to be, which they were correctly surmising, was that there must be a lot of companies getting a bad return. If we fix those, then the entire market and the entire economy improves. And that was the issue, is that there was somewhere between 700 and 1,000 companies out of 4, like 1 out of 4 companies that had a valuation that was below book, that was below the amount of assets they had put in the company.
Which is wild, everybody. And so what happened is this all starts to happen. You can see this return on assets is creeping up for Japan Inc., right? Japan Inc. started at 1 to 2%, got to 4%. Now in 2023, they're at 6%. And that really helps explain this massive rally in the Nikkei. The massive rally in the Nikkei is because you went from companies basically being entirely below the cost of capital to now they're actually pushing above the cost of capital. And so what's really interesting is in 2024, return on assets rose even higher. But here's what's really interesting and why there's still room to potentially run for this, just as the Nikkei has, right, broken to new all-time highs from 2024 and 2025. And that's, if you remember, the dark blue bars are history. The 2 light blue bars are when we take equity sell-side analyst estimates for Japan Inc., for the largest 150 so odd Japanese companies, and we look at it from uniform accounting and what they're forecasting, and you can see they're expecting return on assets to dip down. And that white bar is what the market is currently valuing Japan Inc. to do at this, at basically the Nikkei's new all-time high of over 45,000 yen. It's basically pricing in return on assets to come back in. And if these structural changes are real, then there could be a lot of reason for this to run a lot higher. And I mean, just for context, everybody, let's look at one company that's a good example of this, right? And this is where the idea of these activist investors coming into play. And that's one of the big things that's happening in Japan is you're actually starting to see the success that Steel Partners didn't have. You're seeing other investors now starting to have success with being activists and trying to enact change, because they have to listen to shareholders now. But just as an example of the kind of companies that are going on and like why we think that the idea that return on assets could stay at 5% levels or below might be wrong, it's these changes are real. And so let's just look at one company, for example, right? Mitsubishi Corp. Mitsubishi, one of the companies that Buffett invested in when he invested in all the big trading houses. If you look, right, Joel, and if you want to take everybody through, kind of what we're seeing here in terms of what historic uniform assets were.
So for Mitsubishi, the uniform return accounting numbers, right? This is where we restate Japanese accounting, which is not the same as U.S. GAAP. It is not the same as IFRS. At one point, they even told Japanese companies, you get to choose. You can do U.S. accounting or you can use the international accounting, which is unbelievably confusing when you have two different accounting regimes at the same time. But regardless, over time, we always take whatever accounting the companies are using, and we put them on one global uniform accounting platform, so we have apples to apples. And on those numbers, you see returns that were below 10% and rising to 11, 12 plus percent, maybe around 12. That's a decent return when you've got a country that in total was getting something like 4% return on assets or less.
Yeah. It's like solid, really profitable company.
When you add in the guidance that the companies give, and so it's a little different than in the States where you have analysts, we actually get guidance from the companies on how the next 2 years are going to be. For 2026, we'll have, whatever quarterlies might be available. This is the fiscal year of the company, and that's why it's 2026. Yep. And 2025 is done with because it's the fiscal year that's done with. So an estimated 2026, returns may fall a bit, but 2027 returns should rise a bit. This is based on the company's own guidance, right, for their detailed pro forma financials. And then finally, what does the stock market think is that, no, this is not going to hold. This number is going to collapse. These white bars are saying, here's how bad the company's returns have to be to justify the current stock price, And so if you believe that, no, the returns are going to hold at that 10, 11% level, this stock has got 30, 40, 50% upside. It does.
Easy. Yeah. And I mean, this is the thing, everybody. And, this is the kind of the discussion that, you're starting to see is people are starting to recognize that Japan Inc., if the change is real, valuations like this that you're looking at for Mitsubishi, this is why Buffett and Berkshire, jumped in, because they said, wow, there is a mispricing here because people are misunderstanding this situation. And everybody, there's, we've actually taken a look at some parts of Japan Inc. also. We actually just released a big new special report on a big change that we think is happening, ironically, with Tesla, not with Japan Inc., but there are some parts of Japan Inc. that we think are going to be a really big beneficiary of it. And if you want to hear what we think that big change is on Tesla that could actually also impact Japan Inc. and all these changes, check out Tesla Next Move. That's TESLANEXTMOVE.com. You can see the link at the bottom of the page here. And check out what we're seeing here. And if you enjoyed this and you want to hear more macro research like we're talking about here, drop something in the comment below and hit the like and subscribe button. That's this episode of Altimetry Authority. Thanks, everybody.